Hey everyone, welcome to an exciting show. Exciting show for lots of reasons. First and foremost, you get the guest, my expert back that you always ask for, Anna Kelly. And it's early May. It's the first Wednesday of May, so we're going to talk about May collections. So how you doing today, Anna?
I'm great, Michael. How about you?
I'm doing very well. I am starting to feel really, really good about real estate investing for most of the country. There will be some markets that have pain, but most of the country is in good spot. But why don't we talk about May collections first? Because I know I have my stats and you have yours, and I saw a quick blurb on Facebook about some good news. So why don't we start there?
Sure. So, on the first, which we always don't have everybody pay by the first, but by the first, we were at about 86.5% collected, which was really good news for us because, everybody's been kind of worrying that, April was going to be bad, May was going to be worse. And we actually, for day one collections, were better than normal.
Wow.
And by yesterday, the 5th, we were at 98, 97, and about 91% for our property blocks across central Pennsylvania. So we're doing really, really well for May, and breathing a big sigh of relief.
Wow. So let's, just in case people think this is like 8 out of 9 people, what are we talking unit count? It's about 200-ish.
262, because I just sold a few.
Got to raise that
In
cash.
Central PA.
Yeah.
In Central PA.
So
Yeah.
again, 86% day one. I don't think I've ever seen that number. Yeah, I've never seen that number. And then 90, let's call it what?
Especially when the first is on a Friday.
Yeah, exactly. It's just odd, right? But that's good news. And then let's just call it a blended average of 95% by the
Right
5th.
about, yep.
Yeah, right about right. So
94 and rounding up.
yeah, okay. So that's awesome. So we saw, so again, we're about 150 units, maybe 160 as of today. We were, I think we were only 40 or 44% collected day one. Most of that is Section 8 money that comes in, obviously.
Mm-hmm.
But by the 5th, which was yesterday for us, we were at 86% collected. So we did not quite crack. But in fairness, we're never above 90% by the 5th, right? We
Right.
usually tick over the 90 percentile in our market by about the 10th, for
Mm-hmm.
whatever reason. But yeah, I fully expect, knock on wood, to be above 95% collected by the 15th, which is
Yeah.
frankly a normal month.
Right. Because you always have stragglers. Their paycheck is every other week.
Yep.
Sometimes they had to blow money. They just pay their late fee. They pay a little late.
Yeah.
In our Atlanta market, I have 250 units. And last month on the first, one of the two properties had like 33% on the first.
Wow.
They had this month we had like 57% on the first. And that, again, most of them pay like between the 5th and the 7th. So
Right.
I don't have my updated numbers from yesterday, but it's rising. And we ended up slowly, trickling to be above 93, 97% collected on both of those properties, even though by the first it didn't look so great.
Yeah. So let's add, so both of us were very surprised with April. Again, April, most people had their income from March. So April probably shouldn't have been a surprise to us, but I think it's fair to say, at least for me, May surprised me, right? Just, I did not expect to be, knocking on the door of 90% by the 6th or 7th. Why do you think that is?
Right.
Do you think it's because unemployment checks were hitting and it's supercharged? Do you think it's because of the $1,200 check? Do you even wonder why?
Yeah, I think a couple of things. So I think, when everything in the news is negative, and you see rent strikes and rent forgiveness and people saying, some pretty highly funded rent strike movements coming through the country.
Yeah.
You just say, what's going to happen? How many of my tenants will buy into that and try not to pay?
Mm-hmm.
But generally speaking, I'm a Class B type area investor. And so for the most part, my tenant pool are, above average income. They probably have a little more saved than others. And they care about their credit score. So generally speaking, most of them are very faithful to pay their rent and pay their bills. So I was hopeful from that perspective, but again, you just don't know how many are going to lose their jobs, how many might not pay. And so I was pleasantly, surprised that none of my tenants, at least so far, have, tried to strike their rent or told us they're not going to pay.
Yeah.
I think part of that, we did have a few that have made some partial payments,
Yeah.
and have been impacted, have lost jobs, but they want to use their stimulus checks and their unemployment to pay rent. They're like, as soon as I get this check, I'll
Mhm.
give it to you. Thank you so much for not charging us late fees. And they're grateful that we're not, charging them late fees or evicting. So
Yeah.
I think a lot more people than what the media wants you to think really want to do the right thing. They care about their shelter and they want
Mhm.
to stay living where they can.
Yeah.
So yeah, I think that's part of why you have a fear that they're not going to pay, and the reality was much better than that.
Yeah, I just want to echo that. The majority, the media, for whatever reason, has got on this kick, and they've always been negative, but they are finding every opportunity to go negative, even in just the smallest subset of individuals, which is, I guess they have a job to do and they got to sell ads or whatever the freaking heck they do. But, you have two landlords here that have almost 500 units, and we're telling you a blended average by the fifth is over 90%. And I think it gets better from here, right? I think the country is starting to open up, and May have been the bottom as far as rents, missing rent, because I think
Mhm.
jobs start opening up. I think you have that whole swath of retail and restaurants that a majority of those come back quickly. Some of those will limp through. You have the supercharged unemployment to the end of July, I believe it is. So I think I have less concern about June than I did May at this point. I don't know if you're thinking the same way or not.
I think again, when we talk about everything being so regionalized, with real estate, so okay, nationally, maybe New York is doing worse. And I
Right.
really frankly thought you might do worse being in California, because most of the news I'm seeing is coming out of, Gavin Newsom and,
Oh
and
yeah.
AOC and Quartet, who's the other one? Omar,
Yeah.
trying to say rent strike, and rent forgiveness back to April. So I
Yeah.
thought, man, California and New York are going to be the hardest hit. So I'm
Yeah.
thankful for you that California actually was better.
Yeah. Yeah.
But I,
We do have our
as-
markets. I wouldn't want to be investing in Oakland or San Francisco right now, but Fresno is if you use colors to delineate cities, Fresno is red, where Oakland and San Francisco are blue. So I'm
right,
thankful for
right.
that.
And I think because of where I'm invested, I'm primarily invested in industries that aren't as significantly hit.
Mhm.
But I think when you mention retail, I might not agree with retail. I think that retail is really going to struggle to
Oh,
come back, and a lot of restaurants, hotels, those type of things.
yeah,
So
that's
if
true.
you've got a lot of employees who work for restaurants, hotels, retail, I think that you could still see some pain in
Hmm.
June and July if they don't get jobs easily
Yeah.
back. Because let's say you work in a big shopping mall and people are like, I'm not going to the mall.
Oh yeah.
How many of those little stores are not going to reopen, and how easily can those people find another job without being in another store space? But by and large, unless you're in one of those industries that's really been impacted, and there's a shift in multiple months beyond July when unemployment runs out,
Mm.
I think you're going to do just fine. I really do.
Yeah. And again, I think the good news continues from here. So again, I think there are markets that you can probably count on, let's call it two hands, that are going to be in trouble this year because of reasons that you can predict, right? Las Vegas, Orlando, New York, San Francisco, LA, maybe Seattle. Generally speaking, they were high price markets that were, at least many of those were already unaffordable, and thus they're going to be hit really hard. But again, 95% of real estate across the country is fine. And I'm starting to see good news, right? Mortgage applications to purchase up third week in a row. Um, lending up for the second week in a row. So I think we're going to come out of this just fine. I think you're still going to want to be in the affordable part of the market. I wouldn't want to be, millionaires row perhaps, because I think the high end is oversupplied to begin with. And in an environment where consumer behavior has changed, I think that market is crushed. But I think being a
Yeah.
landlord, the cash flow rentals, I think the good times are ahead. I think it gets better from here. So maybe the stress I was seeing later in the year doesn't happen. I don't know. It's just starting to feel better, I guess.
Yeah, and I will say I've started to read some different publishings that have come out, like by CoStar, where they've actually looked at, from the time that this started through current, where's the biggest pain, and it's been A and C. And so, and again, it's kind of regionalized in different major metros, but A are the ones that are hyper supplied anyway, because you've got all this construction, all this building, and now they're not able to fill these units. Number one, because people can't move because of quarantine, but also because of layoffs, and they're going to have a lot of pain, and they already are having to drastically cut rents to get their units filled up. And that, I think consumer behavior is going to change to where people say, you know what, I'm not as financially stable as I thought. I better not pay an extra $200 a month just to get that sexy granite and stainless steel. So let me stay in this area, but go in an apartment that has a little less amenities. And then, the C, there's a lot of harder hit, like C minus employee tenants who work for companies that have had layoffs, restaurants, etc. But C plus and affordable housing, where you've got Section 8 checks coming in, they're doing okay. But the strongest has been the B class properties. And so that's what we see during a typical recession. And this is just proving out that when it's really, really bad, you don't want to be in A, and you don't want to be in C minus unless you have guarantee checks for the government.
No, I agree with all of that. It's class B, it's affordable housing. I've been very clear. My stuff's class C, C plus. It's not the C minus junk that's, gang trouble and all that. But yeah, I love where we're both at. And I see this is just very clear. Demand is going to go up for what you and I provide. Now, we may have some pressure on rents, like maybe we don't raise rents for a year. Totally okay, right? I'm happy to be full. But when you look to the future, demand's going to be up for what we have. And, when you can lock in cheap 30-year money, we are going to be very, very happy, because the cost of what we are going through today is going to be inflation, at least at some level, and higher taxes. So again, I think consumer behavior has changed. I think that's what happens. The more and more I read about the Great Depression, is it was something that caused consumer behavior to change for decades. And I think we're in that now. And I think what that means for us is people really need emergency reserves. So it's no longer just Dave Ramsey talking about it. It will become a thing, and people will down select, right? I don't need the $1,200 iPhone. I'll take the $400 one. I won't need the BMW. I'll take the Honda, right? They'll still buy. There'll still be transactions. We are consumers. We will just trade down consciously. And that includes real estate. I don't need class A. I'll take class B. So.
Right. And so to 2 points there, one is the lending landscape. So in the beginning, we were all really worried what's going to happen with lending, because there was a lot of really bad red flags. And then the government came in, as we talked about on a previous show, and put in these stopgaps a couple of weeks ago that have helped. But I just saw an article today that some of the CMBS players that were like pulled out for a month, they're coming back in, and I had a property that I had on the market that was, under contract, loan approved, loan delayed. The day of closing, they pulled the loan because they couldn't find a buyer on the secondary market. So I've shifted that buyer to another lender, and they just approved them yesterday, and we're moving forward to close on that property. So, there are lenders that are still lending for good deals. They're going to be a little tighter in who they lend to. And if you don't have reserves, they're probably less likely to let you borrow the down payment from your family and, skate by with a lower credit score. And I think you're going to see some overlays, like additional requirements by the lenders that are giving you the loans on top of what the federal programs allow for. But if you're a good qualified buyer, you have a pretty good credit score, I don't think you're going to have trouble, getting a loan. You might need a little more reserves, which will weed out, people really over leveraging themselves to buy a property. But if you're strong, financially already, then, you can be able to buy rental property and have lenders out there that are willing to lend. Yeah. So I think that's really good news.
Yeah. So again, it really changed for me over the weekend when I'm just kind of reading what's going on. I think we bounced off the bottom, and again, affordable real estate, class B, class C plus stuff. Because again, I think the country is opening up now. This all changes in a heartbeat if we get a huge explosion of cases. But I just don't see it happen. I think we've done enough good things, and people are being conscious, at least for the most part, that I think we're going to get through this together. And we are a consumer-based economy. Keeping us all indoors for another 2 months would do no good for no one. So I'm very encouraged by what I see coming.
Me too. And, one of the things that I look at as a multifamily investor, even though I still buy rental, smaller rentals too, but as multifamily, I thought, man, April and May and June might be so bad that people, big, time professionals that track this stuff and look at values over decades said, we're going to have a 20% easily drop in multifamily values,
Hmm.
especially up in the A or B class. And with rents being paid pretty consistently, I don't think you're going to have nearly the drop, in values based on the change in the NOI.
Hmm.
Means there might not be as many deals as quickly available to us if we want to buy, but it bodes well for our property values really not going down the way we thought they might if
Yeah.
we can continue to keep them full. So, I think it's very important whether you're buying singles or, small multis or large, that you invest in areas where there is more demand than there is supply
Hmm.
and not hyper supply. And in that case, you'll do well, and you can continue to look for properties. In fact, before I said, there's no way I'm buying anything. I kind of keep my feelers out, but I'm going to get through this crisis first, asset preservation mode,
Yeah.
and then start looking. And over the
Yeah.
last week, I've been able to say I'm still in asset preservation mode. We're still, we're
Good.
not loosening the reins and making sure we mitigate all the risk, but I'm out there looking for properties now
Yeah.
and excited to be able to go out and find something knowing I can get the funding.
Yeah, it's so funny. This last week has been something. And then the other thing you talked about CoStar earlier. You and I both saw the same article where CoStar, I'm going to go from memory, talked about $148 billion loss in CMBS over the next couple of years, with the majority of that in multifamily, something like 90% or something as far as the units goes. I think that is going to be proved to be wrong because of what we just talked about. I think that CoStar article was a national review. And I think
Yeah,
what's coming off the table today is national. I still think you will see huge losses in some cities, New York being the greatest example, and Las Vegas being a great example, maybe Orlando. Um, but I think we need to take the national real estate collapse off the table, even for multifamily. Um,
right.
then you go geography, maybe like South Texas because of the oil refineries. We're going to have some geography pain now. Um,
Sure.
that's kind of what I'm thinking now. I think the national collapse is off the table.
Yeah, I think so too, and I hope so. I think there are still a lot of larger multifamily deals that were these value add deals where they ran out of cash
Oh
and they
yeah,
were hoping to refinance. And I still think there might be some trouble there and
sure.
opportunities for us buyers that are a little better financially stable to be able to come in and kind of rescue those assets. But I know these agencies don't want a national collapse and a whole bunch of properties on their books. So I think they're going to work with
Yeah.
their borrowers to try to work out whatever they need to do on loan modifications to save those deals. Initially, the forbearance
Hmm.
rules for agency debt were extremely complicated and complex and tight, but I think they start to loosen those things,
Oh
and
yeah.
that you're going to see much less of a mass wave of properties going into foreclosure than we thought
Oh,
you
for
might
sure.
see a couple weeks ago.
Yeah. And again, still the people with bridge loans and value add opportunities. If the deal's bad with an expanded cap rate, yeah, there'll be transactional things that'll be done, and then there'll be some geography change, but no national 25% haircut or whatever. I just don't see it.
Right.
Yeah.
I agree.
All right. And then again, more good news, right? I think people are out buying and shopping. I mean, I keep seeing more and more articles here in the last 48 hours talking about week on week offers, week on week loan requests. I think most of the country is, I didn't believe it when realtors were talking about this 2 or 3 weeks ago about pent up demand. I'm like, I don't see it. But I'm starting to think that they might be right. We may have a bunch of buyers that, took 8 weeks off. They're like, shoot, I need to get in there the summer before the school year starts next year. I mean, we could have a
Right.
rush.
Right. And the low interest rates, as long as they stay really low, will still incentivize. And just as a personal example, I have a property that I listed literally 2 days before Pennsylvania was shut down and realtors weren't allowed to show properties, sell it. And I've got a bunch of people that want to get in it as soon as Wolf lifts the order and lets realtors take people through. Personally, we have been kind of loosely looking for another house, a little bit bigger, has a pool, etc. Haven't found anything, and all of a sudden, in the last week, there's been a few properties listed on the market that will check all the boxes that we want. We'll just stay where we are, and now I'm like, rates are really, really low. maybe I could be convinced to buy and move. And so, I'm just another one of those buyers who, was kind of, but now, if I can find the right property and get really cheap debt, I
Yeah.
might be convinced to list my house and move somewhere else. So I'm sure there's lots of others like me and these other
Yeah.
buyers that are interested, that are ready if rates stay low and they can qualify for a loan.
Yeah. I think that's all. I think demand is going to be there, but as somebody who studied economics, you not only need demand, you need a yes answer from a lender, right, to be
Yeah.
qualified. And I think we're going to see. I think we're going to. I'm going to say I'm going to be surprised with, let's call it June demand, right? June transactions, because even if you get in the contract today, you don't close till June. So I think
Yeah.
May is still a bad month.
Right.
But I think June, July, August. I think what we've done with the spring selling season is we've moved it 60 days. Where
Yeah.
before I was like, oh, it's gone, it won't come back. It'll be next year. I think we just moved it.
Yeah.
Maybe that's wishful thinking, but
Yeah.
again, I can't look at the data that's coming out and see anything but good news for much of the country. I think
Right.
where I live, the Bay Area is in trouble. We just had a bunch of layoffs in tech, so I think there's some high price markets I've been warning people about, but again, as a cash flow investor, you wouldn't buy here anyway, right? So
Right. Right.
yeah,
Yeah.
I'm pretty excited about what's coming. Any other good news? I think it's just good news abounds. Unlike the last couple of weeks we've been talking, we've been kind of down and scared and nervous. I think both of us have turned around and we're being more opportunistic, and we see good news ahead of us.
Yeah, I do too. And I think especially, even for those properties that have struggled with filling them up or occupancy right now, because there have been some that, can't pay and maybe they will go vacant. There's a lot of people starting to look, but once the quarantines are lifted, and in most states, we're seeing that they're starting to lift quarantines,
Mm-hmm.
in May. And
Mm-hmm.
so whether it's last week or whether it's in the next 2 weeks, you see that these states are starting to open up. So that just gets better and better. It puts more people out there that want to buy, that want to rent, that want to, do whatever they need to do to keep the economy going. So I think if we get through the pain of May, it may take a month or two to see people, getting back to normal. But I think July definitely looks a lot better, and hopefully June as well.
Yeah, that's very cool. Well, I'm excited about what's coming. I think we've been through the worst of it. There's that old country song, if you're going to go through hell, just keep going.
Yeah.
I think we've bounced off the bottom. I'm really encouraged by what's coming. It's not going to be the good old days by any stretch, but again, surviving what we've been through and coming out the other side, it's the American economy, the American dream is pretty strong. It's amazing thing to watch.
Yeah, we definitely have been through it. And I think if we come through strong on the other end, it's going to give us a lot more confidence, those people that are kind of tepid, to continue to do it. And like we say all the time, this is a long game. Real estate, ups and downs. If you haven't learned that after what we've gone through, then you need to keep watching. But really, real estate has its ups and downs, but it is still the greatest wealth builder in our country. And if you play the long game, you can do really, really well.
Well, very, very good. We're going to leave it on that. Play the long game. Real estate is the greatest wealth generator for the average person. Thank you very much, Anna. It's been wonderful.